Imagine earning money regularly without actively working for it. That's the power of dividends, profits paid out by companies to their shareholders. It's like getting a slice of the company's success just for owning a piece of it. Welcome to our video on smart investing and financial independence. Today, we're going to talk about the concept of passive income, particularly through dividend investing. One of the greatest examples of successful dividend investing is Warren Buffett. Known for his wisdom in the stock market, Buffett has built a significant part of his fortune through smart dividend investments. What's fascinating is that you don't need to be a billionaire like Buffett to start benefiting from dividends. With the right strategy, even smaller investments can grow over time, providing a steady income stream. Today, we'll explore how you can potentially live off dividends, just like the investment pros, but with much less initial investment. Let's get started. Understanding dividends. What are dividends? Imagine a company like Apple making a profit. Instead of keeping all these earnings to themselves, they share a part of it with their shareholders. That's what dividends are. It's like a reward for investing in the company. The more shares you own, the bigger your piece of the profit pie. Now, why are dividends so appealing? The beauty lies in their regularity. If you invest in a company that pays dividends, you can receive these payments periodically, maybe every quarter. It's like getting a consistent paycheck just from your investment. Companies like Apple, known for their stability and profitability, are popular choices among dividend investors. By owning their shares, you could enjoy these regular dividend payments, which can be a steady source of income. This makes dividend investing a convenient and attractive strategy for anyone looking to build a steady income stream without constant active involvement. The appeal of living off dividends. Imagine a life where your investments take care of your bills. That's the magic of living off dividends. The aim? To accumulate enough in dividend-paying stocks so that their payouts cover your living expenses. Let's say you spend $50,000 a year. With a portfolio yielding an average 5% dividend, you'd need a $1 million investment to earn that $50,000 annually in dividends. This approach paves the way to financial independence, reducing your need for a regular job. It's about setting up a system where your investments yield regular, reliable income. Picture this. Instead of working each day for a paycheck, your smart investment choices in stable companies like Johnson & Johnson or Procter & Gamble pay you a salary. Patience and consistent investing are key. As you grow your portfolio steadily, these investments can eventually generate enough income for daily expenses. Investment requirements. Think you need a fortune to start earning from dividends? Think again. One of the biggest myths about dividend investing is that it's only for the wealthy. The truth is, you can start small. Many dividend-paying stocks are affordable, and you can buy shares gradually over time. But how do dividends really work? Let's talk about dividend yield, a key term in dividend investing. Dividend yield is essentially the percentage of a company's stock price that it pays out in dividends each year. For example, if a stock is priced at $100 and pays a $3 dividend annually, its yield is 3%. Now consider this. If you want to earn $1,000 a year in dividends and you invest in stocks with an average yield of 4%, you'd need to invest $25,000. Doesn't sound as daunting now, does it? This shows that with a strategic approach, even smaller investments can grow into significant dividend income over time. Practical calculations. Ever wondered how much you need to invest to live off dividends? Let's break it down with an example. Say you want to earn $10,000 annually in dividends. If the average dividend yield of your chosen stocks is 3%, you would need to invest about $333,333. How do we get this number? Simply divide your desired annual dividend, $10,000, by the yield, 0.03, and there's your investment target. But it's not just about the numbers. Choosing the right companies is crucial. Warren Buffett advises investing in businesses you understand and believe in. Look for companies with a history of stable and growing dividends. This could be large established companies like Coca-Cola or McDonald's, known for consistent dividend payments. Successful dividend investing combines smart calculations with wise company choices. It's about balancing the figures with investing in companies that show potential for long-term growth and stability. Common misconceptions and realities. Dividend investing might seem straightforward, but it's not without its pitfalls. One common misconception is that high-yield stocks are always the best choice. Sounds tempting, right? But here's a reality check. High yields can sometimes signal a company in trouble. A stock with a 10% yield might look attractive, but what if the company is struggling and cuts the dividend next year? Your income drops, and so does the stock value. So how do you avoid this trap? Look for stability and growth potential, not just high yields. Think about it. Would you prefer a flashy 10% yield with the risk of losing value, or a solid 4% from a company like Johnson & Johnson, known for consistent growth and dividend payments? This is why dividend investing is more about strategic patience than quick wins. By focusing on long-term stability and growth, you can build a more reliable income stream, avoiding the pitfalls of short-term, high-yield temptations. Strategies beyond just earning dividends. Dividend investing isn't just about cashing in checks. Did you know you can turbocharge your investment with strategies like reinvesting dividends? This is where the magic of compounding comes into play. Let's break it down. Suppose you own shares in a company that pays you dividends. Instead of spending this money, you reinvest it by buying more shares. More shares mean more dividends next time, which you reinvest again, and so the cycle continues. Over time, this compounding effect can significantly boost the value of your investment. Here's a simple example. Imagine you start with $5,000 invested in a stock with a 4% dividend yield. If you reinvest those dividends in 20 years without adding any extra money, your investment could grow to over $11,000 just from the power of compounding. Another strategy is focusing on dividend growth over high yield. Some companies might start with a lower yield but have a history of increasing their dividends over time. Investing in these companies can lead to growing income each year, potentially outpacing those with higher initial yields but slower growth. So ask yourself, do you want immediate income, or are you playing the long game for potential greater gains? Balancing these strategies can help you optimize your dividend investment for either steady income or long-term growth. Tax implications. When it comes to dividend investing, there's a crucial aspect that often gets overlooked: taxes. Yes, dividend income is great, but it's important to remember that it's not all yours to keep. Dividends are subject to taxation, and this can impact your net income from investments. Let's consider a scenario. Imagine you receive $10,000 in dividends annually. Depending on your tax bracket, a portion of this amount might go to taxes. For instance, if you're in a 15% tax bracket for dividends, you'd owe $1,500 in taxes, leaving you with $8,500. So what does this mean for your investment strategy? It's essential to factor in taxes when calculating your expected income from dividends. This helps you get a realistic picture of what you can expect to earn after taxes. But here's a question. Are you maximizing your tax efficiency with your dividend investments? It's not always straightforward, as tax laws can be complex and vary based on your overall financial situation. This is where a tax professional can be invaluable. They can provide personalized advice, helping you structure your investments in a tax-efficient manner and possibly even find ways to reduce your tax liability. Smart dividend investing isn't just about choosing the right stocks. It's about understanding and managing the tax implications to maximize your net income. Today, we've explained the exciting possibility of living off dividends, a journey that combines strategic investing with the dream of financial independence. Remember, dividend investing isn't just for the wealthy, it's accessible to everyone. You can start small and grow your investments over time. The key is informed and wise investing. Understand the companies you're investing in, focus on stable dividends, and don't get swayed by high yields without considering the risks. Reinvesting dividends for compound growth and being aware of tax implications further enhance your strategy. So why not start your journey today? Even small steps can lead to significant results. By planning wisely and investing consistently, you can build a portfolio that not only provides a steady income stream, but also grows over time. Envision a future where you're not just working for money, but your money is working for you, providing financial security and freedom. That's the power of dividend investing. It's a path to a more secure and independent financial life. If you found this video helpful and want more insights into smart investing and achieving financial freedom, don't forget to hit the subscribe button. Your support encourages us to keep bringing valuable content your way. Like what you heard? Give us a thumbs up. It helps more people like you find this video, and we'd love to hear from you. Drop a comment below with your thoughts, questions, or any topics you'd like us to cover next. Every like and comment makes a huge difference and keeps our community growing. Catch you soon, and don't forget, subscribe and join us as we turn the page to the next chapter. Frugally Rich, signing off.